We're back. This time we're doing the practice 7 test stuff. So let's look at this question right here. Control copy, control paste. If a stock's PE ratio is 13.5 at a time when earnings are $3 per year and the dividend payout ratio is 40%, what is the stock's current price? Well, let's do the math. We know that the stock price formula, the stock price is equal to PE ratio multiplied by the EPS. We are given the PE ratio, which is 13.5. You know, let's use a darker color here because I didn't realize this was such a bright image. let's fix that really quickly. A little bit of bright, dark color. Okay, so we know that the stock price is equal to the PE ratio. Apparently everything is bugging out right now. Multiplied by the EPS. Estimated. Do you guys know what EPS stands for? Either of you can go for it.
Earnings per share.
Correct. 13.5 multiplied by 3, which is equal to 40.5. So that's that one. If anyone is curious as to what the dividend payout ratio is for, it's a red herring meant to trick you. You don't actually need it for this question. I know it's a bit scummy, but that is what the thing is for. Moving on to the next question. So let's open the notebook again. Jefferson recently paid an annual dividend of, control copy, control paste, $1.31 per share. The dividend is expected to increase by 4% each year. How much should you pay for this stock today if your required return is 16%? Okay. So for this, we need the amount to be paid formula. So amount to be paid. Apparently, my screen keeps bugging out on me, but that's okay. That will be the annual dividend. You know, I'm just going to put it in the notepad because it's a bit too long to just type out. It'll be this. Amount to be paid is control copy, control paste. The annual dividend multiplied by 1 plus dividend rate, close parentheses, close bracket, divided by, open bracket, required return minus the dividend rate. Pause it if you need to write it down or something like that. So I'll admit that's maybe a bit too long to write by hand, but it's okay. So to do that, we will now 1.31 multiplied by 1 minus 0.04 divided by, you guys know what it's divided by? No? Okay. It'll be 0.16 because that is the required return minus the dividend decrease. So it'll be 4%. So minus, it's not addition. Because the 4% is negative, you actually subtract from negative 4. Well, negative 0.4. What that means is that we're actually adding here. And the reason for that is because the dividend is expected to decrease and not increase. You plug this into your calculator and you'll get 6.29. Okay? And that 6.29 is your amount that you need to be paid. Does that make sense, guys?
Yes.
Okay, good. I hope this makes sense. So the next question is this one. Control copy, control paste. What is the expected constant growth rate of the dividends for a stock with a current price of 87% and an expected dividend payment of $5.40 per share and a required return of 16%? For this, you're going to need this formula right here. P of 0 is equal to and we're going to do d of 0 divided by r minus the growth. All right, so in this case, we are given that it is the stock price of 87, the payment of $5.4 per share, and a required return rate of 16%. So what we'll do is, it's also $87, not 87%. If you guys saw that little typo, I apologize. In this case, we're going to get 87 is out here, equal to, it'll be 5.4 up here, and then down here it's going to be 0.16 minus G. So you'll plug this into your calculator. I'm using the TI Inspire. If you have a different calculator, you just have to solve for G algebraically, but if you have a TI Inspire, you can do solve for G, and the calculator will give you 0.0097932, or approximately 9.79%. Did that one make sense, guys?
Yeah.
Excellent. So then the next question will be seen here. What price would you pay today if a stock required a return rate of 13% and a dividend growth rate is 3.6%, and the firm recently paid an annual dividend of $2.50? Do you guys know? To solve this one, you're going to need this formula here. It is the current price formula. So CP, and I'm not talking about cheese pizza here, is equal to D1 over return rate, so R minus G again. Okay, same formula as last time. So it's actually even simpler because we're giving a bit better numbers here. So we'll be given D1, which in this case will be 2.5 times 1 plus 0.36. I know it's a bit weird, but that is how you do it, because it's D1 and not D0. 5 multiplied by 1.036. The 0.36 comes from the fact that you have a dividend growth rate of 3.6%. Then you divide it by 0.13 because that's the required rate of return, 0.13, subtracted by, as already given, 0.036, which in this case will give us 27.55, and this is in dollars. This right here is the price you pay for the stock today. So to give you guys some time to catch up, if you're writing it down with me, I'll get rid of this side. Okay, on to the next question. The next question is, what should be the price for a common stock paying $3.50 annually in dividends if the growth rate is 0 and the discount rate is 8%? Okay. For this question, we're going to need the formula P of 0 is equal to the dividend divided by the return rate. Well, just the rate, my bad, not the return rate, just the rate. So in this case, we were given that it is $3.50 and the discount rate is 8%. So it will be $3.50 divided by 0.08, and this will give us $43.75. Let me write that more legibly because that kind of looks really bad. Okay, it is $43.75 and 75 cents. Good. So let's erase this side now, just so that we can move on with our life. Good. So here we have the next question. And that question is, what should you pay for a stock if next year's annual dividend is forecast to be $5.25? The constant growth rate is 2.85%, and you require a 15.5% rate of return. Okay. So in this case, we know that the formula of price is equal to D1 over R minus G again. So we got this formula. This formula is the big formula we use a lot in this one. So it'll be 5.25 over 0.155 minus 0.0285. You can either solve this by hand or plug it in the calculator, and you'll get 41.5. And that will be in dollars, as this is your price. So far, we're doing pretty simple stuff, aren't we? No? Okay. So now let's look at the next one. Which of the following is true for a firm, control paste, having a stock price of $42, an expected dividend of $3, and a sustainable growth rate of 8%. Okay? So in this case, we're going to use the KE formula. I know it's not in your formula sheets, but it saves you time if you know it. It's equal to D1 divided by P of 0 plus G. Okay? To get this, K1 is equal to, KE. So to get this one, you'll know that your D1 is its expected dividend was $3. So it will be $3 over, and your stock price is $42. Then you add your growth rate, which in this case is 0.08. Remember, if you have any questions, just blurt them out or something. And if you guys are watching this, just put them in the comments. The number signs will cancel out, and we'll be left with a percentage. We'll be getting 0.1514, which approximately is 15.14%. You don't have this formula. The way that the book wants you to do it is through a different means, but why would I use the means that the book gives me if this version is just faster? Am I right, guys?
It works. If it works, it works. Yeah.
Yeah. Because honestly, the book version, have you guys seen how the book wants you to do it?
The book makes things very complicated at times.
Yeah, the book has no business being that crazy. Okay. Wilts has an earnings share of $2.98 and dividends per share of 35 cents. What is the firm's sustainable rate of growth if its return on assets is 14.6% and its return on equity is 18.2%? All right. So for this one, we're going to need sustainable growth rate. So G, please write it down. Good. G is equal to rho. Okay. G is equal to rho multiplied by 1 minus the dividend payout ratio. So DPR. Okay. So in this case, we are given that it is 0.182. Hold on. Where did I get the return of equity? Okay. Return of equity is given to us here in the question. It's 18.2%, which can be translated mathematically as 0. Okay, that just looks like a really bad number here. It doesn't look like a 0. Okay, 0.182 multiplied by 1 minus, open parentheses, and we're going to go down for a bit, 0.35 divided by 2.98. We're going to close the parentheses here. Now you can solve this algebraically, but if you have a calculator, you'll know that this gives you 0.1606, otherwise approaching 16.06%. And that is your sustainable growth rate, your G, per se. Okay, so if you guys need to get your G, just know that it's your rho multiplied by 1 minus your DPR. All right. You know what, let's use a darker color for this because it's a really bright image. So let's use black for this one. This one is actually a bit longer because there's a lot of steps to it. And it's the ABC common stock question. Do you guys remember this question?
Wasn't there one similar on the homework? If I remember correctly.
ABC common stock is expected to have an extraordinary growth in earnings and dividends of 20% per year for 2 years, after which the growth rate will be settled into a constant 6%. If the discount rate is 15% and the most recent dividend was $2.50, what should be the approximate current share price? I know, really long. But let's start the work. Okay, so we're actually going to need a lot of formulas. So I figure I might as well just write them all out, okay? Formula 1 we need for D1. Okay, I apparently cannot write today. D1 is equal to the dividend multiplied by 1 plus the growth, like this. For the second formula, we're going to need the D2 formula, which is equal to the same thing here. And then for value after year 2, just so you guys know, it will be, so value after year 2 is equal to D2 multiplied by the growth rate divided by the discount rate minus the growth rate. Like that. Good. Very good indeed. So what this means is that I really should be using bright orange. I don't know why I'm not. Now that we know this, we also need to know one last formula. The current shares price, so the current price of the share is equal to future dividends multiplied by, and I know, like I said, this was going to be a really long question with a lot of formulas, but once you have all the formulas and you know the steps, this question really isn't that hard, just a bit tedious. But that's mostly what you do in school quite a lot. So future dividends multiplied by your present value for discounting factors, DF, and your periods of time for this one are your percentage and your time. I know that that doesn't make a lot of sense algebraically, but once I show the work, it will start to make a lot of sense. Good? Great. So now that we have all the formulas here that we need to solve it, let's get D1. We were given that for D1, let's just look at the little notepad here, that we have the most recent, that the discount rate is 15%, most recent dividend is $2.50, that the dividends of 20%, that the growth in dividends of 20% per year for 2 years, and that the growth rate settles into a constant 6% if the discount rate is 15, and that the most recent dividend was $2.50. Now that we know that we can do this. It'll be 2.5 multiplied by, since it is 20%, it'll be 1 plus 0.2. The 0.2 is the 20%, and that will give us 3. So that is our D1. Our D2 is this. D2 will be equal to 3 multiplied by, it'll be 3 multiplied by 1.2, which is equal to 3.6. Thankfully, now we have the D1 and D2, so I can get rid of this top section here. Not because I need to, but because it just makes it easier to have more space. Okay, so now we have D1 and D2, we can solve for the value after year 2. So we'll get this, 3.6, which is D2, multiplied by 1 plus 0.6, 0.06. The 0.06 comes from the fact that the rate settles into a constant 6% if the discount rate is after the 2 years. So then we take this and we divide it by the discount rate minus the growth rate. So in this case, it'll be 0.15 minus our growth rate. And since it has settled down after 2 years, it is only going to be the 0.06, not 0.2. And 0.06. And we put this into our nice little calculator. And this gives us $42.40. Excellent indeed. But we're not done. That only gives us the value after year 2. This does not give us our final answer. One of the big difficulties with this that I think is going to happen is people won't know where to stop. But to help you continue, this is what you write down on the formulas first, and you plan out which steps you're going on to. So now that we have this, we need the future dividend value divided by PV diff percent time. So what we're going to do here, now that we have this, now we have 42.4, we have 3 and 3.6, we can now get this final number here. And that will be 3, which is D1, divided by, and it's going to be by 1 plus 0.15, because this is already after 2 years, plus our big 3.6 divided by 1.15 squared, because this is the second one. Now let's get rid of the section here, because we don't need this section right here. Excellent. Excellent indeed. Plus 42, which we just calced, 0.4, divided by 1.15. And this one will also be squared because this is at the end of year 2. After all, it settles. We plug all of that into a calculator, and we get, does anyone know the answer? Hello? You guys still here?
Still here, but I'll probably be going after the video.
Okay, so then I'm just asking, is anyone even following along, or am I just talking to the void?
You're talking to the hundreds of audience members you will reach through the internet.
Well, damn.
But I've also been trying to review everything else. But let me see. So this one's number 9 on the Chapter 7 practice quiz, correct?
It's $37.39, but yes, it was.
All right.
All right, that's the end of chapter test 7, by the way. Crazy, I know. Am I right? All right. Let's just clear all at this point. That's the entire chapter section done. So let's just reset our whiteboard and look for the next one. All right. Oh, wow. It's 6 o'clock. Interesting. It really is 6 o'clock. Well, damn. That's okay. Okay. So now we go to practice test 8. And this is the what? Control V. A project requires an initial outlay of $10 million, okay? If the cost of capital exceeds the project IRR, then the project has I'm not going to write anything down, but in this case, it is a negative NPV. And the reason is simple. I'm actually just going to put the rules here for which NPV you have. So there's no point in actually writing this down, as this is not a numerical question. If your cost of capital is greater than your IRR, you have a negative NPV. If the cost of capital is less than your IRR, you have a positive NPV. And if the cost of capital is equal to your IRR, then you have an NPV equal to 0. Good? Great. Now we have this doozy right here. Project A. Pretty long question, I'm not going to lie, but it wouldn't be a test question if it wasn't long and tedious. Project A has an initial cost of $80,000 and provides cash inflows of $34,000 a year for 3 years. Project B has an initial cost of $80,000 and provides a cash inflow of $114,000 in year 3. The projects are mutually exclusive. Which projects should you accept if the discount rate is 11.7%? What if the discount rate is 13.5%? All right, so the formula here is the Npv formula again, because we don't love ourselves apparently. So let's get the Npv of project A and it's at 11.7%. Okay, so we know that in this case, because it is 34,000, and then the last one is only 80,000 as the final. And since the A is for 3 years, each with an annual inflow, we know that it is solved like this. We are going to open our bracket, $34,000 divided by, and it's going to be, in this case, it's 11.7%. So it's going to be 1.117 close the power of 1 plus, and we add the same thing again. Okay, 34,000 divided by 1.117 close parentheses squared plus open bracket, it is 34,000 divided by 1.117 cubed. And then because it's 3 years, however, we do have an initial cost of $80,000, it'll be like so. We then plug this into our handy dandy calculator, and we get $2,085.10. Crazy, right? Up next, we need to do the sum of the NPV. Now we need to do the NPV project at B at the same thing, 11.7%. Okay, good. So in this case, because project B has a cash flow in year 3 and not once a year for 3 years, we only have to calculate once. In turn, what that means is we do 114,000 divided by 1.117, like that, And then because it's at year 3, we actually put a cubed here minus the initial investment, which is $80,000. You plug this into your calculator and you get 1798.50, and that's in dollars. Okay? This is also a pretty cool way of solving things, and it requires a lot less math because NPV just loves all the steps, doesn't it, guys? But now that we have these numbers, remember these numbers, write them down somewhere, or just keep them memorized. It's up to you. Now we need to get NPVA at, let's see, 13.5%, because that is what the question is asking us. Okay, I'm a big advocate of writing things down. Personally, I don't take notes on a computer when I'm in class. So here we have NPV for project A at 13%. So it's going to be 34000 parentheses 1 point, and instead of 117, it's going to be 135 plus, and it's to the power of 1, 34,000 times 1.135 squared plus 34,000 over 1.135 cubed. But since this is only requiring 3 years, that's it for that calculation. Subtracted by 80,000 because that's our initial investment. And with that out of the way, the numbers that we should get here will be negative 397.49. Okay. On to the next one, where we need to get it for project B at 13.5%. In a sense, what we're going to do is, instead of having this here, we'll just replace it with 13.5, like that, 1.135. And we erase this number here because we already have it written down somewhere. Hopefully you have it written down somewhere. And you have this number here. You'll plug it into your nice little calculator, and you'll get $2,031.84. However, this is negative. What this means is that since the NPV for 13.5% projects are negative, you select neither of them. And even though A and B have positive NPVs at 17.7%, project A has a higher NPV, therefore you accept A at 11.7%. I hope that makes a lot of sense. Because if it doesn't make sense, I need you guys to speak up and ask questions. This isn't a Zoom link. I can't exactly have you raise your hand.
One more time, just to make sure I got it before I ask any questions.
What'd you say?
Could you please repeat it one more time before I ask any questions, just to make sure I heard it correctly?
Okay. So
just the answer.
Okay, so I'll give you the numbers. For project A, it's $2,085.10. For project B, at 11.7%, it is $1,798.50. NPV of project A at 13.5% is negative $397.49, and NPV for project B at 13.5% is negative $2,031.84. What this means is that since the NPV for the 13.5% projects are both negative, neither are selected. And what this means is that since the NPV for the 11.7% projects are positive, however, A is higher than B, in this case, we accept A at 11.7%, but neither of them at 13.5%.
Yes, that makes sense. Because at A it's positive, whereas at 13.5%, they're both negative, both projects A and B. Got it. All right. Yeah, you're doing great. Yeah, that sounded correct.
Okay, because remember, if you guys have questions, just speak up, okay? You feel free to interrupt me. That's part of why you're here. So the opportunity cost of capital is equal to, in this case, this is not a numerical formula. This is just a concept formula, and the answer is that the opportunity cost is equal to the return that shareholders could expect by investing their money to the financial markets. Okay? I don't really like these conceptual questions, but you need to know them if you want to get a job in this field. That sounds a bit jaded, but it's kind of true. Up next, we have this question right here. What is the IRR for a project that costs $100,000 and provides annual cash inflow of $30,000 for 6 years, starting 1 year from today? So for this, we need the sum of net cash flow again. I know you're probably sick of me writing it, but just for the sake of, refreshing your memory, because I always advocate for writing the equation before you start doing the work. NPV. Okay, seriously, if I keep getting the screen flicker, and I know it doesn't pick it up on YouTube because YouTube runs the videos at 24 FPS. If you're watching this at 120 FPS, you'll get the screen flickers. Is equal to the sum of n. Hold on, I'm on the phone. I got the mail or someone's at the door. I'll be right back, okay? Okay, I'm back. I'm gonna have to edit that out, don't I? Yeah, I do. Damn it. So this will be I is equal to 1 because we start at year 1. If you want to do it at year 0, you'll do I equal to 0. And the formula here, you're going to plug this in, and it's going to be the net cash inflow. So net cash inflow divided by, and it's going to be open parentheses, 1 plus the rate, close parentheses, the time, and then you'll subtract by the initial cash flow. So ICF. And since the investment is 100K and it provides the annual cash flow of 30,000 for 6 years, we are actually looking for IRR in this question. So what this means is that NPV in this question is equal to 0. Does that make sense, guys?
Yes, that makes sense.
Excellent.
Wait, could you say that one more time? I'm sorry.
Okay, so we're looking for the IRR in this question. What that means is that we need to set NPV equal to 0.
Oh, yeah. Okay. Yeah.
Perfect. So in this case, it'll be 0 is equal to, open bracket, 30,000 divided by 1 plus IRR. And this will be to the power of 1. And we'll repeat this all the way to number 6. 30,000 divided by 1 plus IRR to the power of 6, because this assumes we're just repeating it. And then we subtract by our initial 100,000. Okay? What this does when you plug it into the calculator, has anyone actually plugged it in yet, or not yet?
Not yet.
Understood. But when you do plug it into a calculator, you'll get 19.91%. That's an approximation. You can also use Excel for this. It's actually a bit faster to use Excel, but I want to show you guys the steps to actually solve this question. Up next, we need to find the, wait, let me open the notepad. Up next, the subsequent question is, we need to find the IRR of a project with the following cash flows. And our following cash flows in this case are cash at 0. Cash at 0, which is equal to negative 200. Cash at 1, which is equal to 110. Cash at 2, which is 121. And to do this, we need to get IRR again. But in this case, instead of having a consistent number, we need to get the at. It's done like this. At IRR, what we need to have is the value of inflows needs to be equal to the present value of outflows. Okay? Meaning that since CO, so at year 0, we know what the answer is. It's 200 equals 2. Equals, at year 1, it is 110. Oops, I seem to have mistyped that. That's be really bad. So it'll be 110 divided by, and in this case, that number will be 10%, 1.1x. And the reason we know that it is, oh, it's not 1.1, it's 1.0x. And we know it's 1.0 because we're not given any other number. So we just use 1 for the sake of simplicity. You could, in theory, use any other number, but you'll have a harder time calculating this. And up here, it'll be 121 divided by 1x. This x is what we are looking for. From here, you'll solve for x. And once you solve for x, you're going to realize that the number you find here is this one right here. X is equal to 0.1 or 10%. Did you guys understand the methodology for that one? Because that one's kind of vague and it's not really in the formula sheet.
It's understandable.
Yeah, I think I got it.
You think? What does that mean?
Like, I understand up to like I got a little lost on the last step.
Can you explain which step did you get lost on?
The near the second to last one.
Oh, when you solve for x?
Yeah.
Well, what I'm doing is because most of us are going to be using Excel or a calculator. If I really wanted to solve for x, I could do the movement of variables, or I can do the butterfly multiplication that you learned in elementary school, but nobody is doing this exam without a calculator. It would take way too long. So most likely I'm just plugging in for solve x.
Okay, got it.
If you, because I could do the whole solve for all the variables by hand,
No,
but that would take way too long.
Yeah.
Good. All right. So the next one. What is the NPV for the following project cash flows at a discount rate of 15%? So now we're given discount rates. Last time we weren't given discount rates, so we just assumed 1. It'll be the NPV for the following project cash flow. C of 0 is equal to negative 1,000, C of 1 is equal to 7,000, and C of 2 is equal to 700. My apologies, C of 1 is equal to 700 as well. Okay? With those numbers in mind, let's start solving this thing. So we know from previous experience is that our initial investment is 1,000. So we're not even going to try to hide it. Then we add 700 divided by, and since the discount rate is 15%, it is 1.15. Good. Plus, and since the second one is also 700 at C2, we know that it's this divided by 1.15. However, since this is C2, we square it. From here, you plug it into your calculator, and the number that you should get is $138. That one was pretty easy, wasn't it? It was nowhere near as full of steps. Oh, and I misspoke about this. You do need to use a 1.0 because there is no discount rate. So discount rate is equal to 0. So 1 plus 0 is 1.0. I don't know why I said you could do any number. That is incorrect. All right. Next question. Whoa. That was not how that was planned. What is the maximum that should be invested in a project at time equals to 0 if the inflows are estimated at $50,000 annually for 3 years and the cost of capital is 9%? That is a really good one. That's actually a really good question. Do you guys know the present value of annuity formula? Either of you?
The value annuity. I don't think I do off the top of my head.
Okay. Well, the present value of annuity formula is annuity multiplied by 1 minus 1 plus the interest rate minus the to the power of the negative t. It's negative here because it is the annuity. And then from here, you'll divide all of this by your rate. That looks a bit confusing, but let's look at the numbers. We know that the inflows are estimated at $50,000 annually. Okay? We multiply this by 1 minus, open parentheses, 1.09. The 0.9 comes from the fact that the cost of capital is 9%. Then, because this is annually for 3 years, we use -3. We put this to the power of -3. We then close our parentheses and divide by the rate. So it is 0.09. This right here, if we plug it into a calculator, will give us, and this is going to be a really long one, 1268564.73 dollars. That is how you solve for the present value of annuity. Once more, I'm not sure why the professor did not put this on the formula sheet, but it happens, right? Sometimes they just don't help you out as much as they say they do. This is why it's important to study, because when you study, you memorize things more effectively. Up next is this question. Whoa. What is the net present value of a project that has an initial outflow of $36,300 and cash inflow of $115,000, $21,700, 0, and $1,400 in years 1 through 4 respectively? The required return rate is 15%. Okay, we've done a lot of questions like this. Do you guys know where to start? No?
Which one for number for quiz 8?
It's question 8.
Put the initial cash flow for each one, and then just measure out the cash inflows. Use that to find NPV, IRR, etc.
Correct. Although a bit vague in your statements, so let's just show it in writing. So it'll be 115,000. You're correct, by the way. I'm not, dissing you. It's just that's a bit hard to visualize. 1 plus, and since the discount rate is 15%, it'll be 0.15. And this is year 1, so we do it like this. Good. Plus, and since the second one, since it's not the same numbers, it's different numbers, we got to do it again. So 1.7K divided by 1.15. This is squared because it is year 2. Plus, in bracket, we're actually going to be skipping the 0 because it's just 0 and we already know that it's just 0. So it'll be 10.4k divided by 1.15 power of 4, because this is year 4, not year 3. Year 3 is 0. And we subtract from our initial investment, which is, or in this case, our initial cash outflow, which in this case is equal to 36,300. You plug this into a calculator, and the answer that you are given is this: negative 3945.45. In a sense, you do not want to accept this project at all. You are going to lose a lot, right? Right, guys? You don't accept this project, correct?
Yeah.
Good.
Accept any project with a negative net present value, unless like the project gives something greater than the amount it loses, but that's not covered in this class, so do not accept the project.
Correct. Although I'm impressed you knew that second part, that if it gives something greater than what you lose, you can accept it, but that depends on the circumstance. But for the sake of this class, don't do it. Just say no. All right. Next question. And that question is this one. Okay. Control copy, control paste. Which mutually exclusive project would you select if both are priced at 1,000 and your required return rate is 15%? Project A with 3 annual cash flows of $1,000, or Project B with 3 years of 0 cash flow followed by 3 years of 1,500 annually. Okay, so once more, we need the Npv formula. We all know the Npv formula at this point, but it never hurts to rewrite it, correct? Npv, in this case, will be the present value of inflow is equal to the present value of outflow. Good. Very good indeed. So project A, so let's solve for that one, will give us 1,000, and the reason it's 1,000, even though I do not, because it's already here with 3 annual cash flows of 1,000, and if both are priced at $1,000. In this case, we're doing it like this: 1,000. So it's not the same Npv formula, it's a different one, but it also works. Multiplied by, and it's going to be 1 minus open bracket 1 divided by 1.15. And in this case, it's going to be cubed, close bracket, divided by 1.15. I mean 0.15, because you're just doing the rate, not the other number. 0.15 in this case. Let me actually just write it in the line so that it's not as convoluted to follow. 0.15. Okay? Now that you have that there, you realize that this gives you 2,283 minus 1,000. I know that seemed to have come out of nowhere, but if you do the math, this is what it will simplify to. And you'll get this. And the answer will be $1,283. That seems a little weird, I know, but trying to do it the way the professor taught us just takes way too long. Are you guys able to follow that? Because I know that's not in the formula sheet.
Yeah.
Okay, I keep hearing yeah, but then I ask you guys to explain it and you guys can't do it. No offense to you guys. It's just an observation. Project B. Okay, so let's look at Project B. And just so that you guys know which formula I'm using this one, which is 1,000 multiplied by 1 minus 1 divided by 1 plus r. and then it'll be close the parentheses here for t divided by the overall rate. Just so you know, this is the big formula I'm using. This formula I don't believe is in the, it's not in this class's textbook, but if you took financial accounting, this is the formula they use, and it's honestly just way faster. And to prove that fact, let's look at project B. So we all know that project B will be a bit different, however, because project B uses a slightly different formula, seeing as it starts with 3 annual cash flows of 1,000. Project B starts with 3 years of zero flow, then followed by 3 years of 1,500 annually. So what that means here is we get to use the regular formula instead of the project A formula. This was just here to explain the formula used for project A. So doing the NPV thing normally, for B, we'll get 15. You know what, let's just clear all the ink at this point. Okay, so we'll get NPV for B is equal to, and that will be 1,500 divided by 1.15, and it's 1.15 because it is a 15% discount. But since this starts 3 years after the initial investment, this will be a 4 and not a 1. Does that make sense?
Yes.
Plus 1,500 divided by 1.15 to the power of 5, and then we do it one more time, plus 1,500 divided by 1.15 to the power of 6, minus, because we gotta, actually no, I don't think we have to subtract at all, because the subtraction will come after. So you'll do this and you put it on your calculator, and you'll get 2,251.898. But the beauty of this is that now that you have this number, you can subtract it by 1,000 because that's your initial investment, and you'll get $1,251.89. Okay? Here's the sitch. Okay? And the big sitch is this. $1,283 is greater than $1,251.89 by a little over 30. So you pick, so project A just has a better NPV. So we pick project A. Did that one make sense, guys, as well?
Yes.
Excellent. I really like it when things make sense, because when things make sense, we can get work done. All right. On to practice test 8. That was practice test 7, guys. How do you feel for that?
Oh, a little harder. Well, I guess a little bit more work involved than quiz 7. But yeah.
Okay. This is a concept question, so no real math involved here. Which of the following projects would you feel safe in accepting? Assume that the opportunity cost of capital to be 12% for each project. And there is answer A, which has A has a small but negative NPV. B has a positive NPV when discounted at 10%. C's cost of capital exceeds rate of return. And D has a 0 NPV when discounted at 14%. In this case, we pick D. And this is why. A is negative, so it's so we don't pick it. B has a positive NPV when discounted at 10%, but we're not taking this because we don't know if it can be negative or lower NPV. And then C's cost of capital exceeds the rates of return, meaning that the NPV is negative. That's just a bit of a rule one. Now let's look at this one. This is another concept question, I know. Not very fun, but we got this. Dial up 14 story at 6 o'clock. What this means is the Dow index increased by 14 points in today's trading. Does that make sense? Does it?
Let me reread this.
This is a case of understanding lingo, not anything else.
Oh. Yeah.
So you understand the jargon?
Yes.
Excellent. So let's look at this one. Finally, we get to do some math stuff. Control copy, control paste. Well, how long is this question that even at full screen doesn't pick up the whole thing? Weird. A stock is expected to return 11% in a normal economy, 90% of the economy booms, and lose 8% if the economy moves into a recessionary period. Economists predict a 65% chance in a nominal economy, a 25% chance of a boom, and a 10% chance of a recession. What is the expected return on the stock? So do you guys know the formula for this one?
Isn't this one just like sum of all averages? Just 11 times 65, 11 times 0.65, my bad, 19 times 0.25, 8 times 0.10, add that all together, and you'll get 11.10%, I believe.
My friend, you are absolutely correct. Yes, Armand was correct. If you do E of R is equal to, wow, that was really good. 0.65 times 0.11 plus, up in parentheses, 0.25 plus times 0.19 plus, open parentheses, 0.1 times 0.08 close parentheses is equal to 0.1110 or 11.1%. You are correct. Great job. Oh no, it's another concept question, but that's okay. The more concept questions, the less math we actually have to do. Am I right, guys? Control copy. Although the Standard & Poor's Composite Index contains a limited number of U.S. publicly traded stocks, the index represents what? It represents...
Wasn't it 75%?
Yes.
And what is another name for the Standard & Poor Composite Index that a lot of people might recognize more?
Do you know it?
S&P 500, which would explain why market value 75% of all stocks are traded in the top 500 most companies.
SMP or SNP?
Either way, like S&P, yeah.
Yep. Is the name slash AKA. You know, I'm just going to put that in my cheat sheet just so you guys know the truth. Actually, a really good idea to write that. Okay. We're good.
Oh yeah, I wanted to ask, do you want to post your cheat sheet to the study guide or not really?
I really would, except I don't think it'd be able to hold it without causing extreme slowdown issues because of how big it is.
Wait, are we talking about like this like for the quiz or like the entire cheat sheet?
I have an entire cheat sheet for everything.
How big is it?
Multiple hundred pages.
Theoretically?
Docs will slow down like crazy. It won't work. Trust me. Docs
Fair
are
enough.
not
All right.
Docs is not designed to hold too long of a document.
All right. Wait, what was that? What was that one document you had that was like just for the practice quizzes?
It haven't been updated at all, buddy.
All right. Never mind then. Thank you very much.
It is my fault. So, how is it possible for real rates of return to increase during times when the rate of inflation increases? The answer is nominal returns increase more than inflation. That one made sense, right? Good.
Yeah, like go over the rules of the book. Like, just like if you're watching this later, chapter 11 will have the rules that focus on like nominal, real returns, inflation, that kind of stuff.
Okay, do you want to write down the rules here? Just what are the rules? Let me know.
I'm trying to find them. That's the thing. That's the measuring risk.
Okay, so once you find the rules, let me know, and I will continue with that deal.
Yeah, and I can just put them in the study guide. Sounds like a plan.
And let me know where you put them as well, okay?
Yep.
Excellent. Excellent, indeed. So this one's going to be a bit more fun. In a year in which common stocks offered an average rate of 12% treasury bills. Wait a minute, I skipped the question. Control copy, control paste. If the standard deviation of a portfolio return is known to be 30%, then its variant is what? For those of you guys who don't know, to get the variance in a question like this, you just have to square it. So in this case, it'll be 30 squared, which equals 900. And since this 30 is given to us in a percentage, variance is equal to 900%. That one was simple enough, right?
Yes.
Excelente. Here's the next one. And I'm actually just going to give you the formula typed out because there's no reason to write it out by hand here. In a year in which common stocks offered an average rate of 12% and the treasury bills offered 3%, the risk premium, wow, it went up a bit farther. Okay, that's fine. For common stock was, the formula that we use here is the risk premium on stock is equal to the expected return on the market minus the risk-free rate. In a sense, let's go back to first grade here and do 12 minus 3 equals to 9. And since these are all given in percentages, that's your risk premium for a common stock, 9%. Good?
Yeah.
Excellent. Now, you do need to know that because it will be asked, but seriously, that one's a bit simple and dull. But you know there's going to be one guy who gets 12 minus 3, and then he knows it's 9, but he's going to say to himself, but let me just check on my calculator really quickly.
Oh yeah. So I could not find the rules in the book, but the rule is from earlier classes. I wrote at the bottom of the study guide. I'm sorry for interrupting, by the way, but it's essentially the real rate of return is just nominal minus inflation. So as you already said, if the nominal rate increases more than the inflation rate increases, then the real rate would increase.
Okay, thank you very much. You did not interrupt me. In fact, I finished the question just in time.
Yep.
Excellent, thank you very much. So does that make sense for everybody?
Yeah.
Excellent. All right, control copy, control paste for this question again. Over a 20-year period, an investment of 1,000 in common stocks returned an average of 11% in nominal terms and 4% in real terms. At the end of the 20-year, the portfolio value was. Okay, this one is also pretty simple. So first we're going to get it in nominal terms, and then we're going to get it in real terms. Okay? Good. So in real terms, it is 11%. I mean, in nominal terms, it is 11%. What that means is we take 1,000 because that's the number that we typically just use whenever we don't get one. I never understood why, but sure. Multiplied by 1.11 because 11% was a nominal term and then it's for 20 years. You plug this into a calculator and you get f of v is equal to 806.31 dollars. This is your future value. So then we're going to do this for the real terms, and since we know that the real terms is 4%, it is similar, as in it's 1,000 multiplied. Wow, apparently I'm getting the flicker screen. I don't like that, but sure. You're not getting the flicker effect too badly, are you?
No.
Yeah, you're good. Although I'm doing some on my phone, like I'm looking at the phone, so I might not be like having like high enough FPS to see the flicker.
Yeah, okay, that makes sense. So it'd be 1,000 multiplied by 1.04, and the reason it's 1.04 is because 4% is what you get in real terms. The 20 is after 20 years, and from here you get your FV is equal to 2,191.12 cents. This will be in dollars, 2,491. 191. That is your values for that's your future value in nominal terms and your future value in real terms. Does anyone have questions on that?
None here.
None here. Amazing. No, it's this question. Okay. Okay. Over the past 4 years, an investment returned 18%, negative 9%, negative 12%, and 15%. What is the standard deviation of returns? Do you guys know why I shuddered here?
Standard deviation is that much fun, I'm assuming.
No. Standard deviation is fine. That's a calculator problem. It's just the amount of steps. Okay, so let's answer this question. Remember, if you want to write it down, just write it down. So the expected return. What the? Okay, apparently everything is bugging out today. The expected return is equal to the total return divided by the number of years. That's right. Cursor with a mouse. Let's do it. Never do that again. Which is equal to 0.18 minus 0.09. I apparently can't write. No. Did anyone else's screen go black?
Nope.
Yeah, still good on my end.
Okay, my screen went black for a few seconds, but we're back in business. 0.18 minus 0.09 minus, and the reason we're subtracting is because we're given the numbers in a negative return, 0.12 plus 0.15, because the 15 is given to us in a positive number, close bracket, divided by, because there are 4 investments and 4 years, we divide it by 4. Excellent. You plug this into a calculator and you get 3%. I know that's a bit random, but you just get 3% here. Got it?
Sorry, your final answer is 3%?
No. That's just your expected return. Now we need to get the variance. We know that the variance is 1 divided by the number of years. In this case, it's 4. Multiplied by, and it's going to be 0.18 times 0.03. Close. And then it's going to be squared here. Why it's squared? Well, that's because the formula said so. I honestly wouldn't be able to tell you why it's squared, but the math lines up, and that's what matters, right? Times 0.03 is negative 0.09 times 0.03, close parentheses, squared, plus, and then you do open, negative 0.12. No, I got black screened again. Oh, we're back. 0.02 multiply by, oh, my apologies, you're not multiplying here. You're subtracting. I almost messed that up. I'm so sorry. So it's 0.18 subtracted by 0.03, 0.09 subtracted by 0.03, and negative 0.12 subtracted by 0.03. I'm glad I caught that because for whatever reason, I almost didn't catch it either, I think. Okay. Then you add one more time, which will be open parentheses, 0.15 subtracted by 0.03, close close parentheses, squared. And then you put all of this into a calculator, and you will get 0.0185. Now we have the variance. You see why I don't like standard def questions here?
May I cut in for 1 second?
Go ahead.
I just want to confirm. This is going to skip ahead a few steps, but if you have access to Excel, it's possible to be done there. I just wanted to confirm my answer with you.
If you have access to Excel, you just need the number of years and then the percentages, and it'll give you the standard def. If you have a statistics calculator, you can also get the answer this way.
Yes. I just wanted to make sure.
But I'm showing you guys the steps to do it, okay? So now, to get standard deviation, we know that the variance is standard deviation squared. So to get the square root of a number, well, we get the square root of the number. So it'll be 2 is the root, square root of 0.0185 all the way. And then if you're a madman, you know how to calculate this in your head, but if you're not a madman and you just have a calculator, you can get 0.1358, which is equal to 13.58%. Does that one make sense?
Yes.
Are you sure? Then what were the steps?
Well, first you have to find the expected return.
And what is the expected return formula?
It's like the average. So you did, what was it? You did 1/4, and then you just did it, 18, or like the percentage, 18 minus 9 minus 12 plus 15. I think that was right. And
Close
then
enough.
you solve. Yeah,
Close enough.
and then you solve for that.
Step 2.
And then you, I don't know how to explain step 2 to words.
Okay.
But you're basically just finding the variance,
And then step 3 is?
and then you just do the standard deviation of those variance, which is like the square root.
Okay, so I'm going to assume that you're correct. Deal? Okay. But do you see why I don't like this problem? It's not even hard. It's just, it's the same thing 3 times, just with slight variations in the numbers you plug in.
Yeah.
Understood. Next question. And the next one is actually really simple, although it doesn't look it. Control copy, control paste. Stock A has an expected return of 15%. Stock B has an expected return of 8%. What is the expected return on a portfolio comprised of 60% of stock A and 40% of stock B? Before I continue, do any... So apparently something apparently just cut off. That's fine. So let's move back to this section.
Oh, would you mind sharing?
Oh, I'm not sharing my screen. Oops. Oops, not that. Turn off camera. Share my screen. There we go. Screen 1. Record. Okay, do you have my screen?
Yes.
Excellent. Alright, Ish, it's just you and me. Stock A has an expected return of 15%. Stock B has an expected return of 8%. What is the expected return on a portfolio is comprised of 60% of stock A and 40% of stock B. To do this, we need the expected return on a portfolio formula. So expected return on portfolio. To get this, we need to use the respective returns, so RR multiplied by respective weights, or RW. That seems straightforward until you actually calc it, because it's not as simple as just doing both. Instead, what we need to do, seeing as we know that the expected return is 15% for stock A and the stock A is 60%, it'll be, open parentheses, 0.15 multiplied by, and the other one is 0.6 because that is the parentheses, plus 0. What's the other one? 0.08 multiplied by 0.4. Is that correct? Yes, it is. When you put these into a calculator and remember your PEMDAS and don't miss your decimals, you should get 12.2%. Next question. Okay, so Sue purchased a stock for $25 a share, held it for 1 year, and received a $1.34 dividend, and sold the stock for 24 and sold the stock for 26.45. What nominal rate of return did she earn? LUC. Hold on, is dividend given in percent or dollar?
I thought it was dollar. Could be.
I'm thinking about this really quickly. No, these would be in dollar. Otherwise, there would be no reason to add them. So they all are in dollar, I believe. Okay. So what that means to solve this, let's use a different color for this because why not? Let's use a nice bright pink, hot pink. How's that? Pastel pink. Okay. So to solve this, we're going to take the formula for nominal rate of return. So nominal rate of return formula, which is equal to open bracket ending price minus beginning price, and then you add the dividend. And yes, dividend is given in dollars. I just double checked. Divided by beginning price again. I know it's a bit weird, but let's just use that. So what we'll get here is that the nominal rate of return, so NRR, is equal to 26.45 minus 25 plus 1.34 divided by 25. Okay? So what that gives you is 11.6%. Does that make sense?
Yeah.
Yes? Good.
Yes.
Excellent-ish. Excellent. All right, so that's it for math. All I have left to do now is some concept questions. Ready?
Yes.
Okay, so the Dow Jones Industrial Average is. What is the Dow Jones Industrial Average?
Is it like... Wait.
Just what is it?
Is it like the 30 most weighted, or like 30 biggest? I don't know.
It's an index of 30 major stocks.
Oh.
Okay? Does that make sense?
Yes.
All right, so like I said, this will take really a short amount of time. Like Control C, Control C, Control V. Yes. So the variance of an investment's return is a measure of the what? Do you know it?
Yeah, I take a quick look at my notes.
If you want to, go ahead.
Is it the volatility?
Yes, it is the volatility of what?
The rates of return.
And your answer is correct. Why? Do you know why?
I do not.
It is because variance measures the variability or the volatility from an average or mean, and volatility is a measure of risk. Get it?
Yes.
Excellent. 2 more questions and then we're done, okay? The wider the dispersion of return on a stock is the what?
I don't.
You don't know? Control copy, control V. The higher the standard deviation. So the wider the dispersion of return of a stock, the higher the standard deviation. In essence, if you imagine a box and whiskers plot, this makes sense. Correct? Actually, when was the last time you saw a box and whiskers plot?
Probably in high school.
Okay, so your box and whiskers plot, let's just use these for your hypothetical, okay? So let's say this is your mean, and then this is your quarter 2, and this is quarter 1 for hypothetical. What you'll do here is you'll connect these, and then this will be where your whiskers end, and this one will probably go on to some farther number, and so will this. So the wider it is, like here, the wider your standard deviation is. It's actually also simple with a parabola, okay? And the parabola looks like this, your standard deviation is just fine. But if your parabola look like this, yeah, bug out please. Your parabola looks like this, and what ends up happening is your standard def is actually a lot bigger. Does that make sense?
Yes.
Okay, does it actually make sense, or you're agreeing with me?
Like basically wider is bigger.
Excellent. Excellent indeed. Okay. Final question, and then we're free, okay? Which of these is a Pacific risk? Well, that one is unfair. Let me open the midterm review for the guy that he opened. Control F. Which of these is a... He doesn't have it in his practice. Wow, the guy didn't even put it in the practice sheet. Well, effectively, a fire at the company's main factory is in a specific risk. Okay? Do you know why?
Is it because like actually no.
No?
No.
So the reason that fire at a company's main factory would count as a specific risk is because it is linked to the company only in terms of the operation risk and nothing else. Does that make sense?
Wait, so basically just solely related to that specific.
Yeah, to the operations. That's why it's a specific risk.
Okay. Yes.
And that is every single topic covered in the past, well, few classes. Do you have any random questions before I sign off?
None that I could think of off the top of my head.
Good. Is that it?
I suppose so.
All right then. Well then, I hope you learned a lot, because if you didn't, then this was all for naught.
Oh. Yeah, I think it helped a lot.
Good.
I'll probably be reviewing them later.
Excellent. Well then, I hope you enjoyed. Have a nice day.
Thanks. You too.